Hello, today is Wednesday, May 5th, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Willms, and I am the President and CEO of the Milwaukee Company. Joining me this morning is my son, Jake Willms, who is a quantitative analyst with the Milwaukee Company. Nice to have you back again, Jake.
Yeah, thanks for having me back on the podcast, as always.
Oh, always glad to have you. Today, Jake and I will be discussing the tax hikes and new spending programs that President Biden has proposed in his $1.5 billion American Families First plan, which curiously sounds a bit like President Trump's American First campaign slogan, but I digress. These politicians, they just get to me. Before we get started, though, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are Jake and my personal views and not those of the Milwaukee Company. And with that, Jake, I understand you and I are going to switch roles today, and that you will be posing the questions and I will be trying to answer them.
Yeah, I think that'd be kind of fun. Usually it's the other way around. I got some questions here for you about this because I know we talked about it earlier this week, but it's nice to know more details. So I'm ready when you are.
All right, well, let's get started then.
So the first thing I'll say is I understand that the president has proposed spending approximately $2 trillion, just under that, on new entitlements and lower taxes on middle income taxpayers. Do I have that right?
Yeah, that's what they've been reporting, and that's what he announced in his speech. The plan, which comes, less than a month actually after he proposed the $2 trillion infrastructure proposal. It calls for about $1 trillion in new entitlement spending and about $800 billion in tax credits for the middle class over a decade.
So could you quickly tell me what new entitlement spending is? Because I'm not super privy on what that means. Maybe not some of the listeners either.
Yeah, you hear a lot about the tax raises, there's a lot of new entitlements that are going to be part of the program. But I'll just cover some of the biggest ones. How's that?
Otherwise, sure. Yeah.
The first is they're going to make permanent the recent expansion of the child and dependent care tax credit, which is kind of a form of universal income, and they're also going to provide $225 billion for child care, $225 billion to create a national comprehensive paid family leave and medical program, $200 billion for free universal preschool, another $200 billion to make permanent the $1.9 trillion COVID stimulus provision lowering health insurance premiums for those who buy coverage on their own, $195 billion toward ensuring 2 years of free community college for all students, and an additional $45 billion for minority serving institutions, a $62 billion grant program to increase college retention and completion rates. And then there's another $45 billion for helping meet children nutritional needs.
Okay, that's a lot of money. Wow.
Yeah, it adds up to about
it's easy to hear like $2 trillion, right? It's just a single number. But then when you start hearing it in the hundreds of billions over and over again, it really starts to hit. I don't know how they're going to raise that kind of money, but I know they have a plan.
They have a plan to pay for it. The plan raises taxes on wealthy Americans. And what's unclear to me is how those taxes might affect lower income taxpayers, but we'll have to wait and see.
Okay. Do you know what some of those raisers are? Like what specifically are going to be hitting those higher income Americans from this proposal?
So there are 5 key revenue raisers that are included in this plan. The first is to raise income taxes on ordinary income, that is, wages and whatnot, of taxpayers who are who earn over $400,000 a year. They want to raise that rate to 39.6%. The second big one is doubling the tax rate on capital gains and dividends to 39.6% for households making more than $1 million. The third is to repeal the step up in basis in inherited assets at death for inherited assets in excess of $1 million for a single person or 2.5 million for a couple. And there's supposed to be some protections for family-owned business and farms, but we don't know what those are and how substantial those protections will be. And by the way, this change is going to be, I think, controversial, because I actually when I first started practicing law, there was no basis adjustment at death, and it made it very, very difficult to keep track of or to know what assets, what someone paid for assets that they were inheriting. Your parents leave you something, and you don't know what the heck they paid for it.
Right.
So how do you know how much capital gain, what your basis becomes? Anyway, they also want to end the 1031 exchange rules, which eliminates the ability to defer capital gains on real estate exchanges. When you sell a piece of commercial real estate, you turn around and invest that money in a new piece of commercial real estate, you can defer the gain if you meet a whole bunch of different rules. They want to repeal that for exchanges that involve real estate worth more than $500,000.
And that's going to be probably most of it, right? So that's kind of
yeah.
That threshold doesn't really seem very influential.
Well, you're right. It's hard to find a lot of commercial real estate that's under $500,000. And then the last thing is they want to raise taxes on hedge fund and private equity partners by taxing carried interest, subjecting that to capital gains no longer taxing it as capital gains, but rather taxing its carried interest as ordinary income. That's a very complicated area. I'm not going to try and get into all of that here. It's a little bit beyond the scope of our discussion today.
Okay. Wow. So that is a lot of specific targeting going on. So right. I would have to ask then, for our listeners that invest, especially if you're those who are under that $1 million a year, what do you think about this? How should they feel about this proposed change?
Well, keep in mind that, by the White House own estimate, only 0.3% of taxpayers, or about 500,000 people, would be hit by the increased capital gain tax rate. So, you're basically talking about $500,000 people coming up with the $1.5 trillion that that they're looking to recover through taxes. And the other thing to keep in mind is the tax hikes on real estate transaction and carried interest are not tied to income. It doesn't matter how much income you make. Another way that investors might be impacted is that the President Biden's proposal to raise the corporate tax rate will lead to lower corporate earnings, which in turn you would expect to lead to lower stock prices. And more specifically, growth stocks, which have produced some of the biggest returns of the stock market over the last decade, those are going to be particularly hard hit, which will hurt investors in tech companies and the like. And perhaps what might be the most problematic in a lot of ways is that if you're a wealthy investor and your capital gain taxes are going to be going up in the near future, what are you going to do? You're going to sell now, right, to harvest your gains. So you're going to see a really big incentive, assuming this law takes effect at some point in the future. It's not made retroactive, which I think would be very hard to do. I mean, it's possible, but I don't think that's likely to be the case. Once this becomes really evident that this is going to become law, I think there's going to be a lot of investors who are going to be selling stocks to recognize gains and tax them at the low rates, and then reinvesting the proceeds in something very similar, but not maybe identical. And all that trading could really end up distorting the markets this year. Now, all that being said, it's important to keep in mind that this proposal requires approval by Congress, where it'll be subject to negotiations and possible changes. And so it's a distinct possibility that a lot of this will change, and maybe some of the concerns I've just discussed won't come into effect.
Huh. Yeah, I guess I could totally see some shakeups near the end of the year if the timeline holds up. I know me personally, I invest in a lot of tech stocks, and I would probably want to realize the gains and then reinvest in something simpler like a passive portfolio that I could just maintain and hold, even in my more personal account that I trade sort of on a semi-regular basis.
Well, you won't have to worry personally unless you're making over $1 million, in which case I'm paying you way too much. So I don't know that you have to be particularly concerned about harvesting gains, because you won't be subject to the gain tax rate.
Okay.
But you might think to yourself, well, listen, these, the corporate tax hike, that could be a problem. I don't know if I mentioned it previously, but under the prior, under that infrastructure and jobs plan, where the $2 trillion was raised about a month ago, that's going to raise the corporate tax rate from 21 to 28%.
Right. Yeah, that's my thinking. I think that we might see some falling there. I would try to position myself for that if this came through.
And that's, so we have these two bills, and they both raise taxes. One raises on corporations, one raises them on individuals. So it'll be interesting to see how that all plays out. Now, what's really fascinating to me is they're raising taxes to pay for the infrastructure. Congress wants to raise taxes to pay for all that infrastructure spending, about $2 trillion. They want to raise taxes to pay for this plan, about $1.8 trillion. But I haven't heard anybody talk about raising taxes or doing anything to pay for all of the spending that was done in the form of stimulus for COVID. The trillions of dollars that have already been spent trying to fight the pandemic, the pandemic and keeping it from recession. There's no discussion that I've heard about raising taxes or do anything else to pay for that. So the question one of the big problems I see with these tax hikes, these plans, is if you're raising taxes to pay for infrastructure and, increased entitlements, where are you going to get the money to pay back the money you borrowed to do the stimulus programs we had for COVID? Maybe the idea is we never have to pay that back. And I think that's what a lot of politicians are thinking these days. We'll just never pay that back. And, that's a dangerous road to go in my mind. That might be my biggest concern of all.
Yeah, I think it's going to be really, really surprising if we don't have any repercussions from that specifically. But specifically talking about this proposed tax hike, I would be really curious to see how companies position themselves and investors alike to account for this change if it does get approved and doesn't see significant changes in Congress.
Well, time will only tell, son.
All right. Well, I think that is all my questions, so we can wrap up podcast then today. I would say thanks for, switching the roles, letting me ask you questions for a change. That was fun. I want to address the listeners and say that please note that there will not be a podcast next week, as my father will be on a much-deserved vacation. So we apologize for that, but we're not going to make him record a podcast on vacation again, okay?
Thanks, son. I appreciate it.
Please keep in mind that you should conduct your own independent research before acting on any information or opinions expressed during this podcast. And you should not act on anything you have heard in the podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. Other than that, thanks for having me on the show again. Appreciate it.
Thank you, son, and thank you to our listeners for tuning in, and everybody have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.